Hello, am I audible now?
Yes, sir. Now your voice is audible.
Yes,
Okay,
sir.
I hope this continues from here. Sorry for the inconvenience. Okay, just let me know. You can type also if my voice is not audible to you. Okay.
Sir,
So, my name is, yeah,
I have
tell me.
already messaged.
Okay, thank you so much, Jatin. So, my name is Abhishek Pandey, and from here on, I'll be taking your finance classes. So, I have got around 7 years of working experience into industry, and that is into core investment department. And thereafter, I switched into academics and I'm working as an assistant professor in one of the reputed universities of India. Okay, so I have been told that your three chapters have already been covered, and from here on, I have to take the finance classes. So all are on the same page. Am I correct?
Yes, sir.
Yes.
Okay, okay. So before I start, I wanted to know your background, but since the time is very limited, and I have got around 1 hour today, so it won't be possible to take the little briefing from your end. Anyways, we can do that later on also. So before I start, I want you all to know that the basic purpose of this financial modeling, this finance classes would be to do the financial modeling. And financial modeling primarily requires you to have a clear understanding of how you should be valuing a company, how you should be finding out the real worth of the company. When I talk about real worth of the company, it directly means what should be the correct share price of the listed companies. Okay. And this is one of the very lucrative areas in which you should be interested into, because if you master this particular technique of getting mastered into financial modeling, you will be getting good packages and good salaries. And this is actually demandable in the market. Okay. So a lot of courses are floating around in the market. A lot of people are offering this financial modeling courses. But this involves building a financial model core into Excel. And nowadays, a lot of new technologies has come. For example, a lot of new researchers, they are using Python and R also to build up the financial model, and they arrive on the share prices. But but the smartness lies in the core concept. Until you know the concepts involved in the financial modeling, you won't be able to build your financial model, and you won't be able to find out the correct share price of the company. Okay. Basically, our purpose would be to find and to calculate the shares which are undervalued. Okay, undervalued, which can offer us some kind of growth in future. Okay, so we will be primarily looking into the investment part. So we will be trying to find out the stocks which are undervalued. That means which is not correctly priced in the market. Okay. So before taking the today's chapter, one very important topic that you all should be knowing, is the time value of money. Can I can I can I hear from you that how many of you are already aware of the time value of money?
Yes, sir. I am aware about that time of value of money.
Okay, anyone else apart
Yes, sir.
from
I have an
Jatin?
idea.
Okay, very good, very good.
I remember little bit.
Okay, what about others?
Sir, I know
Can
little
just take
bit
a
of
Yes,
yes or no.
sir. I am
Okay,
also aware of it.
very good, very good. Nice. Good to hear that most of you are aware of time value of money. I'll just recap this because this time value of money concepts will be used extensively into building our financial model in Excel. Okay. Also, I like you to know that you should be good enough in knowing the shortcuts in Excel. Okay. From here on, we'll be whatever we'll be studying in Excel only. Okay. So time and again, I'll be repeating few shortcuts. Okay, in Excel. So you should be noting it down somewhere. That will help you a lot. Okay. So I expect you to sit with a notebook and a pen also to note it down. Or if you are live on a laptop, so you should be having a notebook. or you should be having a separate laptop to practice. Okay, so let me quickly share the screen with you. Just a minute. Can you all see my screen, everyone?
Yes, sir.
Yes.
Okay, okay,
Sir.
okay. Yeah. Can you all see the Excel file, everyone?
Sir. Yes, sir.
Okay. Okay. So, can someone help me? What is the definition of time value of money?
Sir, I can explain.
Yes, please try.
Sir, time value of money is related to the discounting principle, where we
Okay.
can know about the future value of the money. For example, the dollar value in hand, what is the future value of the dollar is to be that there is an we have to calculate the present value, future value. These are we calculated in the time value of money.
Very good. Very good. So we'll just try to filter this a little bit. Okay, whatever you have said. Okay. Just assume that you have this 100 rupees today. Okay. Today means I'm writing today. Okay. So I'm giving you two options that I'll be giving you this 100 rupees today, or the another option I can give you that I'll be giving you this 100 rupees, same rupees 100 tomorrow. Okay. So which is better for you? This option or this option? Today or tomorrow?
Today.
Today. Obviously today, because you
Sir,
can
today
utilize
option.
this money. You can utilize this money, right? You can buy anything, or what you can do, you can use this money. Okay, you can take this money today and give it to your friend. Okay, in exchange of 110 rupees tomorrow. You can just lend this money to someone who is in need, right? So in a way, tomorrow you are going to get from your friend what? If this gets materialized, if your friend returns you 110 as promised tomorrow, then you will be having 110 in place of 100. So you got 100 from me today, and it will become 110 because you use this money, right? Okay, you use this money. You got the utility from this 100 rupees today. But what if I would not have given this 100 rupees today? Okay, uh, will the situation will remain same? Can you derive some utility from this 100 that will be getting tomorrow? Today you won't be able to, right? So this is called time value of money. Okay, so every money has got some value. Okay, with the passage of time, every microseconds that is passing, the value of money is decreasing. So how we define this? How we define this? The value of rupees today, value of rupees today is worth, value of rupees 100 today is worth more than value of rupees 100 tomorrow. Okay, so this you can write and you can explain this. Okay, so how do you define the value of rupees 100 today is worth more than value of rupees 100 tomorrow, right? Is this clear, everyone? Okay, is this clear?
Yes, sir.
So in place of 100, you can use 1000 also. In place of 100, you can use 1 rupees also. Okay, there's no problem. The value of rupees 1 today is worth more than value of rupees 100 tomorrow. Okay, now just tell me, if this is the situation, like today you got 100 rupees from me and you gave that 100 rupees to your friend and he returned 110 tomorrow. So what return you are getting? What return you are getting? Suppose you earned this 110 tomorrow, okay, with an investment of rupees 100 today. So what return you are getting? So return is just this 110 minus this 100. Okay, 10 rupees of return you are earning. In percentage terms, this will be 10 divided by the initial investment. Okay, so this divided by this, and this is nothing but in percentage terms, this is 10%. Am I correct? Correct.
Yes,
So
sir.
in a day,
Sir.
in a day,
Yes, sir.
in a day, you got a return of 10%, right? Okay. And you are standing here today. Okay. Suppose I'm writing this today here. You are standing here. Okay. Today. So whatever is today is known as present value. Whatever you have today is also known as present value. Okay. I'm talking about the current situation, present value. So present value is 100, right? And whatever we talk about the future, that means tomorrow is what? It has not yet come, right? It will come. So whatever is likely to come in the future, that will be known as future value, right? Okay, so can we just say that this is our PV, okay, and this is our FP, okay? Future value, short form of future value is FV, and this short form of present value is PV. What is PV? It is 100, and what is FP? It is 110, okay? And this 100 rupees is turning into 110 in just 1 year, right? It is just taking a time of 1 year. Or you say not 1 year, 1 day. 1 day. Practically, this won't be possible that in 1 day you will be earning 10% of return. This is not possible, especially in India. Okay. Until unless you are into some different kind of business. Okay. You won't be earning this much of return in 1 day. Okay. So suppose I'm assuming for the benefit of everyone, suppose I'm assuming that this return of 10% someone is getting in 1 year. Okay. 1 year. 1 year is again, can we write this after 1 year? Okay, after 1 year. So whatever is not today is the future value, right? So 100 rupees, if someone invested and after 1 year, someone is getting 110, okay, that means he's earning the rate of 10% per annum. Can we write this PA per annum? Because this is the return of 1 year. Okay. Now this future value, okay, this future value, just a minute, future value, can we write this as a PV? It's PV multiplied by 1 plus 1 plus some rate R. Okay. Can we write this? If I am writing this particular thing, let's try to observe very carefully. Okay. If I'm writing this, can we match this left hand side and right hand side with the values given over here? Three values we have. What is R? R is the rate, right? Okay. So future value is what? 110. So just calculate the right hand side. Okay. If you calculate the right hand side, in place of PV, I'll put 100 because PV is 100, right? Right? Multiplied by 1 plus, I'm selecting this one. Close the bracket, hit enter. What you are getting 110, which is equal to future value. So this formula is in a way correct for 1 year, right? I hope you understood the formula, how this future value is getting calculated here. Did you understand, everyone, how this formula is getting calculated?
Yes, sir.
Yes.
Yes, sir.
Okay, okay. So just try to understand another way. Okay. Suppose you have 100 rupees today. Okay. 100 rupees today. And you are lending this 100 rupees to your friend. Okay. And he is promising you to return 10% next year. Okay. So this is your present value. This is your PV. Okay. In future, he'll be returning you 10%. That means that money will be nothing but 100 plus 100 multiplied by 10%. Okay. So that will become 110. Okay. See the formula here. If you take D14 common, so what is D14? It is 100. Okay. If you take this D14 common, okay, so I'm just taking this 100 as a common. Okay. Cannot we write this 1 plus R. What was R? It was 10%. Okay, and this is nothing but 110 only. See, the formula was this, right? So from these both the components, you take the D14 common. And what is D14? D14 is 100. Okay, so formula will again become this 100 multiplied by 1 plus R. Okay, the same formula I have used here. Okay, so this formula, which is in bold, this is known as your time value of money formula. In short, we call this TVM. TVM, time value money formula, time value of money formula. I hope this is clear. Okay, one more inclusion in this formula is that when you close the bracket on top, you write n, small n. Okay, raised to the power n. Okay, for 1 year, the value of n will become 1. Okay, now try to understand this formula further. Okay, now this future value is after 1 year. Okay, now what if whatever you have earned for 1 year at the rate of 10%, you don't want to waste this money, you don't want to keep this money idle. Okay, you again want to invest the complete money further for 1 year, and the rate of interest will remain same. So after 2 years, okay, what the formula will become? After 2 years, your future value will be equal to 100 multiplied by, just try to see the formula, 1 plus 10%, close the bracket, and this is equal to 110. Again, this will be invested for another 1 year. So again, 1 plus 10% you will do, and this will give you the value of the future value after 2 years. So just this, the same term has been multiplied again. So cannot we write this is into multiplication? Suppose this complete term is x multiplied by x, that will become x square, right? The same thing will get repeated, and this will give you 121. So as and when, as the number of years increases, this power will be written like this. Okay, suppose someone invested the money rupees 100 today for 3 years. So after 3 years, they'll be getting a return of, this will be present value. Okay, multiplied by 1 plus the rate. Okay, and raised to the power. Help me, please, everyone. For 3 years, the value of n will become 3.
3.
Hit enter, and you will get 133.1. So this is also known as compounding. So what is happening? Your money is getting compounded every year. What is the meaning of compounding? You earn interest on interest. Here your interest was 110 minus 100, right? That is 10. Your principal was 100. You earned an interest of 10. So total sum total will become 110. Now again, this money will be invested for another 1 year. So in a way, the interest you earned, that is also getting invested along with the principal. Okay, when this happens, this is known as compounding effect. Okay, so when future value increases with the present value and with some interest, that is known as compounding. Okay, so every year as we move ahead, okay, if you suppose we draw a timeline, for example, this is 1 year, this is 2 years, 3, 4, and likewise, if we move, okay, your future value for a PV of 100, okay, this will increase. Okay, so this is present value multiplied by 1 plus, if I freeze this 10%, because every year this will remain same. So for freezing any cell, what shortcut key you use? This will be F4. Okay, the moment you press F4, this cell number will appear with a dollar sign. Okay. So column, in front of the column also $1 will appear, and in front of the row number also the dollar will appear. That means that particular cell number I8 will get freezed now. Okay. Raised to the power 1. Okay. So this will give you 110. And if you drag this further, you also need to freeze one more cell here, and which is your F12. Okay. This. So again, you will keep your cursor here and you will click on $sign. Okay. Now you drag this. Control C, Shift, right arrow, and to Control V, you see. And this is the beauty of Excel, that once you are done with one calculation, you just use the shortcuts and you will get the values. That means the value of ₹100 today will be equal to value of will be equal to 161.051 after 5 years. Okay, this is the effect of compounding. Compounding increases the value in the future. I hope this is clear, everyone. I
Yes,
hope
sir.
this is clear. Okay. Now, if all these are your future values, right? See here, it is clearly written. All these are your future values. I hope this is clear. Okay. But what if I tell you convert all these future values into present value? So it can be other way also. Okay. Once you converted PV into future value, present value into future values, so that time you will be using the formula of compounding, this formula, time value of money formula. But in the question, it can also be asked, and in financial modeling, you will be using this particular trick. Okay, that is why I'm teaching you this one. It may be asked to you to convert this future value into the present value. So you will be using the same formula. What will be the formula present value from this formula? Can someone tell me? Can someone tell me? Just use the mathematics.
Yes, sir. Sir, PV present value into 1 plus R की power n divided by future value.
No, 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 no. PV will be equal to
Future value.
FP divided by, right?
Future value divided by 1 plus
Future
R power.
value
R power.
divided by 1 plus R raised to n.
Raised to the power n.
Uh,
Same formula we are using, just using the mathematics, simple mathematics. Okay, so now if I ask you to calculate the present value of 110 today, what is the present value? It is the current value, today's value. Okay, so your future value is here. Use the same formula here. See here. So future value is this divided by 1 plus rate. You will be using this. Okay, rate will remain same. Again, you need to freeze this, right? So use $sign. Okay, and close. Okay, and then raise to the power this one. Hit enter, you will get 100. That means the value of is 110 after 1 year is equal to 100 today. This should be your answer. It should be matching. Okay, in all these cells, your answer should be 100. Okay, let's do this. Just do Control C and then select the cell and press Control V. You'll get the answer. Check the formulas.
Sir,
Yes.
sir, I had a question. Could you please show the formula once again?
Which formula you are saying? Tell me.
Sir, the X formula that equal to inch and then the row, that one.
The formula is in front of you. Tell me the cell
Okay.
number if you have any doubt, or the formula is given in the screen.
Okay, sir.
See, in H13, this is the H column. Okay. This 121 value is in H13. Okay. H means H column and 13th row.
Okay, sir.
Okay. Divided by 1 plus I8 is your rate of interest. Okay. I have freezed this because everywhere I'll be using this rate only. Okay. And this H12 is your number of years. I don't want to repeat the formulas again and again. That is why I have written this 1, 2, 3, 4 in one line. Okay, I've just copied and pasted it. So slowly, you will also learn all these tricks once you are sound in Excel. Okay, so this requires a lot of practice. Don't worry, you will get used to this. Okay, so once you start working into the industries, you will know all this thing. That is not a challenge for you.
Okay.
The you should what is important for you is to understand the concepts, what is happening, and how you should be using the formula. You should have control in your hand. You should be knowing what formula is getting used. If you have any doubt, you can just let me know, and you can challenge someone which the formula is incorrect or it is correct, right? So I just showed you that how do you convert future value into the present value, and how you find out the future value with the help of present value. Okay, so just now we converted all the future values into the present value. This process is known as discounting. Okay, Jatin was talking about something called discounting, right? So you just discounted, right? You discounted all the future values, you converted them into the present value. So this is known as discounting. You converted them into the present value. You tried to find out the worth of some sum in the future, worth of a particular sum in the future today. Okay, that process is known as discounting. Discounting. Okay, this is known as your discounting. Let me write this. And what is the opposite of discounting? It is compounding. Is this clear, everyone? What is compounding and what is discounting? These two terms.
Yes.
Yes, sir.
Yes.
Okay. So once you are done with this, remember that once we start dealing with the financial model in the Excel, we will be calculating unlevered. Just write this. Just try to understand. Unlevered free cash flow to firm. And I guess you already know about what is cash flow. Just let me know. You know how to calculate the cash flow, free cash flow? Balance sheet
Yes,
cash
sir.
flow and P&L has been covered, right?
Yes, sir.
Yes, sir.
Okay, so this unlevered and levered, you need to understand what is this unlevered and levered. Okay, so see, every company, whosoever is functioning and doing the operation, carrying out any kind of business in the market. So, do you know what is capital structure of any company? Have any idea? What do you mean by capital structure?
Debt to
Anyone?
equity 2:1.
Yeah, that is debt to equity ratio. That is okay. So
Yes, sir. I
basically,
have a
any
basic
company,
idea of it.
yeah, just let everyone know.
So the capital structure is the proportion of debt and equity in the capital of the business to continue its operations.
Very good.
So,
Nice.
uh,
Yeah,
so capital structure, it refers to the mix of various external funds
very
is known
good.
as capital structures where we can define the capital of the company, nominal capital, authorized capital,
Very
pay.
good. Very good. In a
Yes,
way,
sir.
everyone is talking about, yeah,
Sir, there are like four types of capital inside a company. Authorized capital is the permitted amount that the a company is allowed to operate on. Issued capital is the number of shares issued by the company.
hmm,
Subscribed is the amount taken uh, by the shareholder, and the paid up capital is the amount that the company got from the shareholder.
very good. Nice explained. So you guys have fair idea about what is capital. So in a way, those of you who are not aware, just try to understand. Every company, they need fund to start the operation, right? To start the operation on to start any kind of business. So they will be arranging funds. Either they can arrange fund from their own if they have surplus money, or they can borrow from their family, from their friends. But that typically arranges very less amount of money to start the business. borrowing funds from your friends, your family members, father and mother, will arrange very little amount of money. Okay, so there are various sources from where company or any firm arranges the capital, right? So typically we study four type of sources from where the capital can be arranged. So first one is the equity. Okay, the other one is your debt. The another one is your retained earning. Okay,
Yes, sir.
retained earnings. Just a minute. Yeah, you have any doubt?
No, sir.
And the other one is your preference shares. So someone was talking about the capital mix. So this is the mix. So suppose a company needs around 50 lakh to start the operation. Okay, 50 lakh. So what they can do, they can just plan, just think, just try to understand. They can source this 50 lakh, okay, from these four various sources. Okay, for example, they can borrow this 10 lakh from the equity market. They can further they can further go for 20 lakh from debt market. Then again 10 lakh from retained earning. And what is remaining? How much more money they need?
10 lakhs.
10 lakh, because they need only 50 lakh, right? So remaining is 10 lakh. Okay. So from different sources, they would be raising fund. Okay. So different sources have different benefits. That is why they go for sourcing these funds from different mix. Okay. So slowly, you will also understand that why someone should not be focusing arranging fund from the one area only. There should be a mix and there should be a balanced mix. Okay. We also study this concept in our capital structure, corporate finance. Anyways, so this is the capital structure of the company. Okay. For our understanding for this particular chapter, unlevered free cash flow to firm will primarily focus on these two things. Okay. We'll be removing these two things for now. Okay. Rather, I should not be removing that for in-depth analysis, but since I need to make this simple for your understanding. So I'm just taking that there is a company which has raised fund from these two sources only, from equity and debt. Okay. So the firm which has raised fund from equity and debt. So equity funds, whosoever has given this money to the company, they will be known as equity shareholders, right? Equity shareholders.
Yes, sir.
And whosoever has given this 20 lakh, they will be known as debenture holders, right?
Yes, sir.
They will be known as debenture holders. So primarily, they both have a stake into the company. Suppose there is a company called ABC which has raised the fund. Okay. So now suppose the company has earned a profit. Earned a profit. I will directly jump into something called EBIT. You know what is EBIT? Anyone?
Yes,
Sir,
Earning
Yes, sir.
before interest and tax.
Very good. So it's earning before interest and tax. Okay. And this is also known as operating profit. Operating profit of the company once your all the direct expenses, indirect expenses, and your non-cash expenses has been taken care of, right? So then the company is left with EBIT, earning before interest and taxes. From this, if company pays out the interest, and who are paid interest? This debenture holders will be paid interest. Okay, suppose there is a company which has earned a profit of say 10 lakh. Okay, just a minute. Okay, and now they had raised a capital of 20 lakh, 20 lakh from issue of debentures, and they had promised that they will be paying 10% annual coupon. Do you know what is coupon? Anyone? Coupon
Sir.
is the annual interest
Interest.
amount
Yes, sir. Interest
paid
rate.
to the debenture holders. Okay. So what is the interest obligation, annual interest obligation? If suppose the company has raised 20 lakh from debenture holders and they have promised that they will be paying 10% interest. So what is the interest obligation, annual interest obligation?
2
2
lakhs
That will
lakh
be
rupees.
2 lakh. And how do you get that 2 lakh?
at 10%.
20 lakh into
Multiplied by
10%.
10%. Very good. So this becomes 2 lakh, right? After you deduct this interest from EBIT, so you will be left with, tell me,
Earning EBT.
EBT, or you call this as a PBT also, right?
PB.
Okay, so I'll just write this. This is your earning before tax. So this amount is your nothing but 10 lakh minus 2 lakh, 8 lakh. So tell me here, who is the owner of this 8 lakh?
Equity
Equity
shareholders.
shareholders.
The
Only,
shareholders.
only they are the real owners of this 8 lakh. They can put a claim on this 8 lakh. But here, who can put a claim on this money? 10 lakh.
Sir, I think maybe
Preference
after preference
shareholders.
share, yes,
No, no, no,
Preference
no, no.
shareholders and equity
I,
shareholders.
I'm not talking about any preference shares. I'm just assuming, that is why I told you before that company has raised from equity and debt only. So we'll keep this simple. So only two
So
interested parties are there, equity
debenture
holders and
holders.
debt holders. So this money belongs to both, right?
Yes, sir.
Because I have not deducted the interest part yet. I'm just asking about this one, right? So both of them will be putting claim on this 10 lakh. If you pay this 2 lakh, they'll be happy. Now they won't be bothered about this money. So now this money belongs to the real owners of the company, that is the equity shareholders. So if company has not paid to both, okay, this situation is known as unlevered. That means it has not yet been levered. The moment we exclude the interest of debenture holders from the money, this will become levered. Will you remember? Here it was unlevered. The moment we excluded this interest part, that means we excluded the debenture holders from the money, this will become levered. I hope this will be clear to you.
Sir, I have
Yes,
one
sir.
doubt.
Yes, tell me.
Sir, basically, levered and unlevered firm, which has I studied in the previous during the MBA program. So,
Yes.
sir, you can tell. Well, I am suggested to me that I am correct or not. Sir, levered firm basically in which there is a debt ratio is present. Unlevered firm is that there is a no debt is present.
That is okay. That levered firm and unlevered firm. But here we need to understand that unlevered means the effect of interest has not been excluded. Okay. Why? I'm talking in terms of money only. I'm talking in terms of money only.
Okay.
Okay. Money means cash also, right?
Yes.
Cash. And we are studying about cash flow. So cash flow is again money, right? So company, they earn cash, right? And this cash flow can be earned from three activities, right?
Yes, sir.
Investing,
Operating
operating,
and
and financing activity.
yes, sir.
Okay. So
Yes.
whatever is the free cash flow, because again, there is a formula of calculation of unlevered free cash flow. I have not yet taught to you because we have to study this. Okay. And for that, we have to understand the concept of called NOPAT, net operating profit after tax.
Okay.
I'm not yet come on that. Okay. So
Okay.
just explaining the concept of cash flow. So just try to understand that since the effect of interest has not been excluded from whatever cash is available with the firm, so that situation will be known as unlevered. Will that be okay?
Okay, when the company does not have the cash flow, that's
No, no, no,
called
no. Company has the cash flow. Company has
okay.
the cash flow, which can be claimed by both. Just write this, everyone. Right. The free cash flow, just write whatever I'm writing. Free cash flow available with the firm, which can be claimed by both debenture holders and equity shareholders. It's known as unlevered free cash flow. Is this clear?
Yes,
Which
sir.
can be claimed by both debenture holders and equity shareholders is known as unlevered free cash flow. Our objective would be to calculate this unlevered free cash flow in the financial modeling that we will be doing in our Excel. We'll do this, don't worry. So every year we'll be calculating the unlevered cash flow using the formula of NOPAT. There are other adjustment also which is required in this NOPAT. We'll study that. Okay. Once we are done with the calculation of unlevered free cash flow, okay, what we do, we deduct the debt proportion, okay, to exclude the effect of this leverage. Okay. So at that time, in order to find out the worth of the equity share, we exclude the debt proportion. I'm not covering that, okay, because again you will get confused. Slowly we'll reach onto that stage because concept is important. Again, I'm telling you. So for now, just try to understand it is that cash flow which is available with the firm which can be claimed by both debenture holders and equity shareholders is known as unlevered free cash flow. We'll convert this unlevered free cash flow to levered cash flow. Okay. Is this clear?
Yes, sir.
Sir, what is levered cash flow?
See, just try to understand. There's something called FCFF and there's something called FCFE. Okay. So this is known as free cash flow to firm. Free cash flow to firm. Okay. And this is known as free cash flow to equity shareholders. Okay. So firm includes both. It's the mix. Firm belongs to both equity shareholders also and debt shareholders also. Whenever company, suppose they go bankrupt, so at that time, these both will be putting their claim on the company. Okay, so that is why combining these two are known as the firm because they are making the capital structure of the company. So they both have the contribution in the capital structure of the company. So that is why this is known as free cash flow to firm. And other name of free cash flow to firm is your unlevered free cash flow. Okay. The moment we exclude the effect of this debt holders from this free cash flow to firm, this will turn into
Levered form.
free cash flow to equity shareholders, or we simply say free cash flow to equity.
Understood.
Okay. Understood? So firm includes both. Whosoever has put their money into the firm, they will put a claim. So that will be known as your unlevered free cash flow. The moment we exclude the effect of everyone else apart from this equity, only equity will keep separately because they are the real owners of the company. We just try to find out the worth for the equity shareholders. Okay, so that money will be known as free cash flow to equity shareholders. I hope this is clear, everyone.
Sir, like if
Yes,
we
sir.
have preference here also in
Mhm.
source of capital, so we have to
Mhm.
the preference share capital also from to get free cash flow to equity shareholders.
Yeah, just a minute. See, in preference shares also we have different type of preference shares. Okay, so again we'll have to see that we or the company has issued convertible preference shares or non-convertible preference shares. Okay, but again to find out the real, what is the difference between debt debentures, debentures and preference shares?
Yes.
Yes, sir.
Yes, sir.
What is the difference?
So preference shares have two important preferential rights.
Can you be
The
little
first
louder?
one is,
Can you be little louder?
yes, sir. Sir, is my voice clear now?
Yeah, it's clear.
Yes, sir. Sir, preference shares, shareholders have two basic preferential rights.
No,
Which
no, no,
are
no, no,
that
no, no, no. That all you have studied in your curriculum. You need to know some very important concepts.
Uh,
Okay.
can I tell?
Yeah. Yeah, yeah. Tell me.
Sir, basically, preference shareholders are those shareholders where we can get the does not have the voting right. First of all, in preference shareholders,
That is okay. That is
when
okay. Everyone knows that. Tell me the
in,
answer which we are looking for.
okay, in
So,
we can talk about the dividend in
Very
preference
good.
shares.
In this
Uh,
preference shares, we are assured of the certain amount
dividend.
of dividend, right? For
Yes.
example, company, whenever the company issues the preference shares, they issue like this, 10%. Again, there will be a percent, but this will not be the coupon. This will be known as dividend. Okay. Preference shares will have a face value. On that face value, the investor would be getting 10% dividend. For example, 10%, 1,000 face value preference shares. It will be like this. So this percentage will again be there in preference shares. So if this has been issued by the company, so every year whosoever has invested into this preference shares, they'll be getting how much dividend? They'll be getting 1,000 multiplied by 10%. That is 100 rupees. Okay, but this will be known as dividend. Whereas in the case of debenture, if some company has issued 10%, okay, 10%, okay, 10%, 100 face value, 100 face value, okay, and every debenture will have a maturity date also, okay, and this has been issued for 5 years, okay. So here every year they'll be getting interest. So terms would be different. Debenture holders get the interest, that is the coupon payment, 10% of this 100 face value. They'll be getting 10. And here the preference shareholders, they get dividend every year based on the agreed percentage in which they entered. Okay.
sir, uh,
Yes.
also debenture means interest have to pay means compulsorily uh,
Yes.
whether the company has profits or not.
Yes. Correct. So this debenture holders, they'll be paid before the preference shareholders and the equity shareholders. They get the preference in payment from the company side, debenture holders. So even if the company is not in profit or in profit, they will have to pay this interest to the debenture holders. But this preference shareholders, again, this is cumulative or non-cumulative, that depends. If it is cumulative, so if company does not pay the dividend this year, so the preference shareholders will get the cumulative. That means the remaining part also next year. For example, if certain investor was supposed to get 100, but since the company was not in profit, so they could not get rupees 100 this year. So whenever they will get the dividend next year, when the company turns into profit, they'll be getting the cumulative dividend. That means 100 of this year, 100 or 100 of the previous year again. Okay, but if the preference shares the investor has bought is non-cumulative in nature, so whatever preference that has foregone in the past that was not paid will not be paid in the future. So that is why there are different types of preference shares. In financial market, we have different kinds of financial instruments. So whenever you go and buy certain instruments, you need to be little careful while buying. You should be knowing what are the features of the financial instruments. Okay. Now, after this debenture holders and preference shareholders, then comes the normal equity shareholders. Okay. So if someone was asking me that, sir, if there is a exposure of this preference shares in the capital mix, so again the effect of that particular thing will be excluded or not. You will have to exclude. You will have to exclude. Who was that? Who was asking this question?
Right.
Okay. So again, you will have to exclude the effect of this preference shares because we are primarily bothered about the worth of the value for the equity shareholders. What is share price? For example, today, just a minute. For example, you are working on developing a financial model for Dixon. Okay, Dixon Tech, which is currently trading at somewhere around 14,000 rupees. Okay. Okay.
Okay.
So whosoever buys the one share of Dixon Tech, he will be the equity shareholder, right? Equity shareholders. Okay. So we are primarily focusing more onto the equity shareholders. Equity shareholders who are interested into buying the shares from the market. Okay. Whosoever buys, they will become equity shareholders. So we should be deciding at what price we should be buying this Dixon, whether this price which is trading in the market is correct or not. This is the current market price. If I write this CMP means correct market price, current market price. But your model, the financial model that you will be developing, your model suggests that it should be around 15,000, your model. So you call this that there's opportunity in this particular stock, right? You can still invest. That means there is an upside of around 1,000 points. So you'll be calling this undervalued. But if your model suggests that it should be for 13,000 only, so that means it is overvalued. I hope this is clear. So we'll be dealing with undervalued, and overvalued. Either your analysis will tell whether the stock is undervalued or it is overvalued. I hope this is clear.
Yes, sir.
Yes, sir.
Okay, so today we'll be ending our session here. Okay, again we'll connect on 11th and we'll further explore the remaining part. Okay, we'll be talking about something called beta, that is the risk part of investment. We'll be also talking about some return. Okay, we'll be also talking about risk-free rate. Okay, we'll also talk about some advanced model which is known as your CAPM, capital asset pricing model, and the last thing which we should be knowing is your WACC, weighted average cost of capital. Okay, for your information, I'm telling you that all these sessions are getting recorded. Okay, so if you feel that you should be revising the concepts again, you can go and watch the session which was done today. So in order to revise again. Okay, before coming for the next class, you should revise the concepts, whatever has been covered today, because all these time value, PV, FB will be used extensively.
Well,
Is this clear?
how we will analyze that if a share price will be undervalued or overvalued?
And that is what is our objective. We'll build our model, financial model.
Okay, sir.
Okay.
Thank you, sir.
Okay, everyone. Take care. Bye bye. Good night. Enjoy.
Thank you, sir.
Thank you, sir. Good night.
Good night.
Thank you, sir. Thank you, sir. Thank you, sir. Good night, sir.
Good night. Good night, everyone. Good night.